In this video, we want to look at my cohort-based model and try and answer two questions. Will they become profitable? And if they will, when might they become profitable? We'll be playing with some of the key variables and understanding their effect on when Lemonade could become profitable. So I have this new model called a cohort-based model. It is available to my Patreon members, so if you want to get a copy of it yourself, feel free to join my Patreon. It goes all the way back to the data we have till 2018 Q1 with a number of main inputs at the top. It looks at each quarter and calculates how much income each quarter would make over a descending or a period of time. For example, Q1 2018, that quarter, it looks like they're going to make 29 cents in Q1 2018. But then the next quarter down, 26 cents, and then the next one 24, and next one 22. That's because a lot of the customers in that cohort are going to be churning away. And if you do that for each quarter and then stack them beside each other so that each one starts in the appropriate spot, you can then sum up the total income at any given time based on this quarterly descent. You end up with this huge sort of wedge-shaped plot of data here that descends down. And then I've summed that up and also summed it up at the top so we can compare it more easily. And then for each quarter, I have a spot where I can toggle yes or no, whether the synthetic agents are being used for that quarter. And if they are, then the math will change. I have some logic built in, so the math will change and the appropriate adjustments will be made, and also some conditional formatting will highlighting will turn on. And if synthetic agents are on, then I have 9 quarters down here, or about 27 months as domain calculated would be the payback period, typical payback period for the synthetic agents, where they're collecting 16% of the premium. So that's kind of how the synthetic agents work. You're reducing your operating expenses up here because your amount you're spending on customer acquisition goes down relative to the amount of growth you're actually experiencing, but then down below you're collecting less premium for the next 9 quarters or so as you're paying back the general catalysts for the synthetic agents dollars. The main inputs or variables or assumptions with this model are what is the amount of synthetic agents, and are they being used? Are they being used again into the future? Are they not? What are the numbers with them? Are they at 25 million a quarter provided, like I have input right here? Are they higher? Are they lower? What percentage of your customer acquisition spend are you using? I'm assuming, as Domain showed in the video he helped me with last time, that they're going to convert $1 of customer acquisition spend into $3 of in-force premium. Is that steady? Is that changing? Ultimately, all of that is just answering, how quickly will the top line grow? Whether you have the synthetic agents or not really affects that, and how much Lemonade wants to grow. That's a major variable we can play with, and it really affects the outcome. The next would be your lifetime loss ratio. So for each cohort, I've actually all the way going back in time here, I used a slide from Lemonade's Investor Day where they showed their predicted cohort lifetime loss ratio. From Q1 2021, they had 86% and then down to 61% of Q3 last year. So I was using those values because for each cohort over time, yes, the loss ratio might be higher at the start, but then it should get significantly better as worse customers churn out, as poorer customers are even canceled by Lemonade as part of this churning out process. So in theory, that should get better over time. So right now in the sort of base model, I've input their lifetime loss ratios. That's a huge variable and a huge question we'll discuss. And their lifetime annual dollar retention. So what will be the lifetime annual dollar retention? Will it get better? Will it get worse? I've just put that in as 87% going forward, and then actually have it at 90% next year going forward. So slight improvement as they have more products in more places. So less reason for people to churn. Then another big variable is the sales and marketing fixed, what I'm calling, which is I've split sales and marketing customer acquisition spend from sort of fixed S&M costs, and non-S&M operating expenses. So everything else other than your sales and marketing. You add those together, what kind of those more fixed operating expenses that you should have in theory great operating leverage around, what's the growth rate of those? So we're going to look at a whole bunch of cases that are slightly modified from each other and compare them to one another to see the effects of all these variables. But let's look at, first of all, the base case, what I'm calling with let's say no synthetic agents. And then I have base case with synthetic agents we'll look at here shortly. But just assume in this case, no synthetic agents. I have in-force premium of 2027 around, Q3 of that year, around 2.4 billion of IFP. That number comes from a slide from Investor Day that Aaron Gray on Twitter also pointed out, where it showed 2027. This is their base case. They had about 400 million in restricted cash by 2027. Also in Investor Day, they showed that they're planning to structure the reinsurance likely around a 6-to-1 ratio, meaning for $6 of in-force premium, they need $1 of cash that's restricted. So if you go off of that, I think that's a huge hint that they're probably like $2.6 billion in-force premium range, not 2.6, $2.4 billion range, somewhere around 2027. So that's roughly where we've modeled that. It's a little bit higher, it continues to grow, and of course would continue to grow, but that's roughly where the base case I'm shooting for. Again, I have the lifetime loss ratio for my base case leveling off at 61%, exactly from this slide at Investor Day. Maybe it would even get better than that. It's certainly showing like a continuous improvement, but these are fairly unproven numbers. We don't know. They're obviously LMND themselves is just predicting these from their data, as it's a prediction over the lifetime of a cohort. But 61% as my base case there, we'll be playing with that variable. Annual dollar retention, I have leveled off at 87% throughout. And then sales and marketing, I have at about 2% quarter-over-quarter growth rate. You look at total operating expenses over the last 5 quarters has been relatively flat, fairly minimal change. Even just last quarter was only about a 1% quarter-over-quarter change. And comments from management has said that they expect to see a lot of operating leverage coming here from this point forward. So I'm at about 2% relative to, the top line's growing more like 20% and then 30 and 40%. Then my ad spend to IFP conversion, I just have it set at 3 throughout. Okay, so now we're going to look at a number of cases, and each one we're going to change or play with a different variable and see the results on the model, and specifically see when LMND might reach profitability depending on that variable input. So the base case, and I'm calling no synthetic agents, no SA here. The base case, if we just plug that through, and we are growing to, again, around 2.4 billion IFP around the third quarter of 2027, kind of like that Investor Day slide, around that range there. Then we get to an operating expenses growing about 2% per quarter, and we get to profitability in very, very tail end of 2026 into 2027. Even 2027, we look up the sum of that is about 98 million, and if we flip back to Aaron's tweet here, we had about 100 million adjusted EBITDA in 2027 according to the slide. So very on track with that slide. Keeps growing out from there. Even by 2030, we're doing something like over $1 billion in adjusted EBITDA. Okay, next we're going to look at the base case again, but no synthetic agents, but maximum growth, as if LMND just cranked up the growth themselves. The 2027 third quarter there, we're at 4 billion in IFP as opposed to 2.4 billion. So they just really crank up the growth. And we'll see, you can compare same time point here between the two models. What it really does is it shifts your profitability sooner. So in the first model I showed you there, we're at about beginning of 2027, very end of 2026 profitable. You shift, if they go higher growth, you shift the profitability maybe to the beginning of 2026, end of 2025, if they're really, really pushing for massive growth or can achieve that sort of growth. Now let's look at the base case again, but with synthetic agents turned on, starting in Q3 this quarter right now for the next 6 quarters, 25 million a quarter. With the synthetic agents turned on, again, looking at the same time point here to compare between the base with no SA and with SA, we flip back and forth. You can see no SA with SA. It shifts profitability forward a little bit. So in the base case, again, 2027, end of 26. With this case, we're now a little bit further, more mid 2026, showing some profitability. Second quarter, maybe even of 26, close to breaking even between those two scenarios. And in the base case, again, in 2030, we had about $1 billion and change of adjusted EBITDA. In the base case with the synthetic agents, where you're pulling that profitability forward, where you're having more growth sooner, we're actually at about 1.4 billion in adjusted EBITDA. So that's what the synthetics agents really do, is they're pulling the profitability forward because you're fueling growth, but your operating expenses and other fixed expenses are very, very slim. And again, this is all assuming a lifetime loss ratio of 61%, which is cascading through each of these cohorts. Next, I have the base case with extended synthetic agents. So essentially, say they get another contract and they pile that contract on top of the next one. I have for the next 6 quarters, sort of what they've outlined so far, 25 million a quarter, covering up to 80% of the CAC spend, getting 16% back. And then I'm saying for the next 6 quarters after that, they're going to have 50 million more provided as synthetic agent funding, and they'll actually take only 50% of the customer acquisition spend and then take 10%, because Daniel mentioned in a tweet that this is proportional to 16 and 80. So if we're moving that down to 50% and from 80, then we're going to be 10% payback for the synthetic agents from the premium there. And what this does is it moves profitability all the way into kind of the end of 2025. And this is versus the case before with some synthetic agents, but not as much. This is profitability. It is here in sort of mid 2026. So again, moves it forward a couple more quarters into maybe 2025 range. And if we compare this extended synthetic agent to the totally base case with no synthetic agents effect, you can see it shifts again almost 2027, the start there, back at least a year sooner in sort of beginning of 2026, maybe end of 2025, just starting to become profitable. Again, if you want to see this model yourself and play with all these variables yourself, you can get full access. Just join my Patreon. And a number of people have been joining lately, so thank you for all you guys who have been joining that group there. The next case I am calling base with synthetic agents. So it's kind of like this one where we had the 6 quarters of synthetic agents that we know are happening for sure. But then I'm saying a 71% lifetime loss ratio. So 71% lifetime loss ratio. Before here, we had this trailing down from based on investor days, the investor day slide, 75 to 61%, and they've kept it there. This one, we're basically saying it doesn't get any better than 71%. 71%, that carries all the way through. And then you can see the effect between this one, we're only reaching profitability in maybe 2028. And if you compare that to the base case with synthetic agents, where profitability was more like mid 2026, around then. So about a year and a half later, it has a huge effect. That whatever that lifetime loss ratio is something I think we really need to think about, investors, whether that is accurate, whether that is precise. If that is actually true, this slide from Investor Day, then I think Lemonade is for sure going to be successful. The biggest question mark is this really accurate or not? I think it probably is accurate, because Lemonade would have cohort data all the way back, multiple years back, even before they were a public company, where they're looking at cohorts of customers and seeing how they change over time, and then seeing the lifetime value of this cohort over maybe 5, 6, 7 years, while the cohort churned, all the customers eventually churned away to almost no more customers. Oh, they had a lifetime loss ratio of 85% or close to that. Maybe it was 90% or high 80% even quarters previous or cohorts that they had data for before Q1 21. And you should start to see a trend as you have more products that have greater premium and you get more selective with the right customers you want. You should be able to actually measure and see. They would have data to show, hey, we think this is actually a cohort is trending toward. And it makes sense in my mind, because whatever the case is, maybe it's 100,000 people in a quarterly cohort, right? And you have 100,000 people. There's going to be certain people that are more risky than others. And some of those people, you're going to just cancel their policies. Some of those people are going to have claims. Some of those people might just be more turbulent people in general and leave. And then eventually you should weed it down to the people that are in a more stable place in life, are just paying their insurance premium year after year, and are maybe very low risk customers or low chance of actually ever having a claim. So in that case, then you could, over time, you might have a higher loss ratio on a cohort. Maybe it's, maybe this cohort, this has 60% here, maybe initially they're 80%, this cohort of people, or even 90%, the first quarter or two of their life. But then over time, the customers that are remaining should be much safer, and you get better and better, probably much better than 60%. Maybe it's 40%, maybe it's 50% loss ratio on the remaining customers from a cohort over a span of time. And then they become very profitable to kind of this average. But it's a big effect. Changing that from 61% to 71%, moves your profitability about a year and a half later. And if we go all the way out to 2030, in the base case with the 61%, we're at the 1.4 billion in adjusted EBITDA. But in the 71% case here, by 2030, we're at 589, so less than half the profit by 2030. So huge. It doesn't mean that Lemonade would fail if the lifetime loss ratio is still like 71% or in that range. Maybe they even do more synthetic agents in this case, which is the next model that we'll look at right here. So if I flip to that one, I have again the same synthetic agent scenario panned out for another 6 quarters at a higher amount. And in that one, we have profitability in mid 2027 versus the previous one, which was only the lower amount of synthetic agents effect there, was 2027, 2028. So moves it forward at least a couple quarters, a little bit of an effect there. Having more synthetic agents, again, has that same positive effect. I don't actually think getting more synthetic agent funding would be a problem for Lemonade. I had a good comment on my last video from Bitly 1120. He said, from synthetic agent General Catalyst perspective, this could be a lucrative business. They set a limit of the money they lend to Lemonade, $150 million in this case, and then they can recycle the money infinitely. They can do this with many other young companies, then pool those loans, securitize them, and recycle. They can borrow money from banks with much lower cost to get leverage. And I think he makes a good point. I feel like this would be a good opportunity for a lender like General Catalyst, and my feel, if it's successful, General Catalyst or others would be able to lend Lemonade even greater amounts of funding if they wanted it, if they needed it. Okay, now let's look at the base case with just 6 quarters of synthetic agents, but 75% lifetime loss ratio. So we had 61% as the base case, 71%, now we're at 75% all the way through, and they don't get to profitability here until 2029, and then 2030, they're at 276 million adjusted EBITDA, so not super great if they're only going to hit 75% lifetime loss ratio. Again, I think something closer to what they revealed on Investor Day is more likely, but we want to cover all our bases here. And again, the base case profitability, mid-2026, base case with synthetic agents, mid-2026. And with the 75% loss ratio, crank that up, then you're going from mid-2026 all the way like 2.5 years later till 2029. So huge difference. And again, I did the same thing, 75% LLR, but with extended synthetic agents. So we've pushed that out as well for those next few quarters. And instead of 2029, we're moving that again forward from 2029 to about the very end of 2027. So definitely a positive effect once again. Now we're going to look at the base case with synthetic agents, but a higher operating expense growth. So I have the customer acquisition spend operating expenses, so it's a sort of a fixed sales and marketing and other OPEXs. OPEXs, is that a word? All of those growing at 4% quarter over quarter, which is about 17% annually. Again, I think this is a little bit high. I would guess we're going to grow more like, I hope it's closer to 2%, but I want to show this scenario just in case. So in this scenario, we're getting to profitability at slowly kind of second quarter of 2027 and slowly transitioning and ramping up. Eventually 2030 having $950 billion in adjusted EBITDA. This is the one with 4% growth. This is the one with the 2% growth. It shifts your profitability back quite a few quarters to mid-2026 instead of mid-2027 and a slower change over there. You also have that 1.4 billion in adjusted EBITDA versus the 950 in the 4% OPEX growth. Now the exact same scenario, but I have 6% quarterly growth in operating expenses. So about 26%, much less operating leverage. There's still some there because the top line is growing something like 44%. But in this case, you don't get to profitability till 2029. It's not really great if your operating expenses just keep running away like that. Again, versus the 4%, we're at maybe 2027, and it's basically adding a couple years, not till mid 2029, and our profitability 2030 is only 249 million. Also, in some of these cases or scenarios, I haven't really pointed this out, but our cash we definitely need to raise money somewhere before we even reach profitability. Just let alone to have enough cash to be above zero, but also to maintain the minimum requirement for the amount of premium they have. Now, the same scenario, the 6%, I did the extended synthetic agents, so I pushed those out, more synthetic agents happening. And if I compare those, now in this case, it's only 2029. In this case, we're reaching there at the start of 2027. So huge shift in that green line, having that more synthetic agents there, even though operating expenses are growing 6% quarter over quarter. In the next case, we're going to look at very extended synthetic agents with 6% operating expense growth. So those are still growing 6%, but I'm saying they just really pile into, maybe they have a couple quarters of lower synthetic agents. They have 3 quarters, and then they add more synthetic agents or more deals on top of the existing one. And so I have next 9 quarters, I have $100 at 80%. So they're really pushing for synthetic agent spend. And of course, that's affecting all of those quarters. So it's taking some of your profits out there, but you're shifting your profitability forward into the now. It's interesting then, you actually start to almost get profitable in 2025. And then maybe you're hovering around that point after the synthetic agents drop off, but you still reach profitability by 2027, even with 6% operating expense growth. Which I really hope they don't have that kind of operating expense growth. That's versus this base sort of synthetic agent case where they only get to profitability in 2029, and they only have, see some here, 250 million in adjusted EBITDA. But with this extended, where they really crank up the synthetic agent amount and push that forward, you get profitability much sooner. You could keep scaling in theory. I mean, this is all in theory, that they could keep growing, which insurance market is so huge and they can so easily expand. I think this is very possible. Then in this case, by 2030, they're, let's say, 18 billion on IFP. And they're actually, it's one of the most profitable cases. They're actually at 2 billion in adjusted EBITDA by 2030 because they've done so much synthetic agent spend and they're really pushing for the growth. If you haven't caught on already, is that one main conclusion. Basically, if you're taking some of these assumptions at face value, and maybe this, there's a limit in every quarter of how the sort of low-hanging fruit they can grab in the areas they're in and the products they have to get a 3-to-1 conversion ratio or better. But if you assume that 3-to-1 ratio holds true, basically more growth, whether it's top-line growth that they're spending or maybe even better is synthetic agent growth where you're minimizing some of your OPEX. It gets you to profitability sooner and to more profitability because in this case, they're actually at that. They get to 2 billion adjusted EBITDA by 2030. Next, I want to look at the final couple cases I want to look at is, first of all, 4% operating expense growth, but a 71% LL or lifetime loss ratio. So kind of a little bit pessimistic on both of those variables. So 71% and 4% operating expense growth. That gets us to profitability in 2029. And then 2030, starting to turn a corner, having 174 million in adjusted EBITDA. If we do the exact same scenario, we flip on the extended synthetic agents where we have 6 more quarters at 50 million and 50% of the growth fueled by that, then we shift our profitability back to 2028, the second quarter, and by the end of by 2030, 580 million in adjusted EBITDA. So if we compare those two, flipping back and forth, you can see that it moves profitability ahead by about at least a year and a half. So I hope this was valuable to you. If you want to, again, get full access to this, feel free to join my Patreon. Then you can make your own copy. And it's actually fun to play with the variables here and toggle off the amount of synthetic agent effect you're thinking may occur. I hope we showed basically that if Lemonade grows more, or at least within these assumptions and variable inputs, if they just grow more, whether it's their own top line or more synthetic agents, it's very good for them. And my guess is something along these lines is probably the reality, or at least would be my prediction or guess of what may happen. It's encouraging because this base case follows this slide from Investor Day quite closely in the values that come out there. But then if you tag on top of that the synthetic agents that have now been announced, then rolling back here, then we're getting to profitability more like probably mid 2026. And you kind of wonder, at one point will the market realize that's coming? Maybe it's in 2025, maybe it's in 2024, maybe it's even sooner than that. It's that I do not know, but I think this is encouraging that I really could see a case to be made where they start to have positive cash flow somewhere in the mid 2026 range. And in my mind, if they do more synthetic agents, which I don't see why they wouldn't, say they add that on, or they're adding 6 more quarters at a higher amount, then we could be creeping. Profitability might become very obvious that we're going to reach profitability like in 2025, which even at the end of 2025 start to break even and become profitable. So that'd be very exciting, and I can't see why Lemonade wouldn't just add more synthetic agents over time to fuel and push towards that profitability. So I mean, if you ask me and I had to guess, I probably think maybe Q4 2025 is the first profitable or break-even quarter, or maybe Q1 2026 around that range if they push for a case like this. Otherwise, it might be more of a 2026 range. And what's great about this sort of model is once we start to see how Lemonade does the accounting for their synthetic agents, make sure we're on the right track with their synthetic agents and understanding it, everything's crystal clear with the effect that it's having, then we can, once we sort of know, like say they announce a new synthetic agent deal, we can use this model and probably pinpoint pretty accurately when they're going to become profitable, and probably a few years before the market would really realize that. It was a bit of a long video. I hope this was really helpful for you. Again, feel free to check my Patreon. Thank you to everyone who is supporting the channel that way. Really appreciate it. Really appreciate everyone who's online in the YouTube comments, just watching, also in the Lemonade community on Twitter. So thank you so much for watching. And remember, it's in the bag.